Hey everyone, welcome back to Corporate Decoder. In this video, we will be diving into a comprehensive shareholder report for the Independent Franchise Partners US Equity Fund. This report gives us a crucial look at how this fund performed financially and what strategies were employed. If you want to understand the financial nitty-gritty of investment funds, stick around. And if you appreciate unbiased deep dives into corporate filings, hit that subscribe button and join our Discord community, linked in the description below. Let's start by looking at how the fund actually performed over the last year for the period ending the 30th of September 2025, the Independent Franchise Partners. US Equity Fund returned a solid 25.23%. Now, that number might sound good on its own, but what really matters is how it stacks up against the competition and its own goals. The fund's benchmarks, the Russell 1000 Value Benchmark and the S&P 500 Index, saw returns of 9.44% and 17.60% respectively. So it looks like our fund here outperformed both benchmarks handily. The report mentions that this strong showing was despite the fact that the fund does not own the popular growth and artificial intelligence related technology stocks that were driving the market. This suggests a strategy focused on different types of companies, perhaps those with more durable, intangible assets, as the report states they seek to achieve an attractive long-term rate of return by investing in companies with a high and sustainable return on capital. The narrative around the fund's performance highlights a key point. Equity markets were largely driven by a narrow group of tech stocks. The fund, however, intentionally did not own these, prioritizing valuation reasons. This is a classic case of a fund manager making a deliberate choice to diverge from the hottest trends, betting on their own analysis. The report also notes that geopolitical risks and the threat of trade tariffs weighed on markets, but the fund managed to generate much of its excess return during this period. This pattern reinforces what they describe as the franchise return profile, aiming for attractive long-term returns while also trying to insulate investors from the worst market downturns. It is interesting to see that their strategy of selecting companies based on high and sustainable return on capital and durable intangible assets allowed them to navigate periods of market uncertainty and outshine broader market indices, even without chasing the most hyped tech stocks. Diving into specific stock performance within the fund, we see some eye-popping numbers. On the positive side, Warner Bros. Discovery really took off, with an 84% return. Oracle also performed exceptionally well, up 67%, closely followed by Nintendo at 66%. On the flip side, Kenvue saw the biggest drop, down 27%. Bristol-Myers Squibb and Estee Lauder were also among the bottom performers, both down 33% and 37% respectively. What is noteworthy here is the impact these individual stock movements have on the overall fund. For example, Oracle contributed a massive 243 basis points to the fund's gross return, meaning its strong performance significantly boosted the entire fund's gains. Similarly, Warner Bros. Discovery added 235 basis points. On the negative side, Kenvue's 108 basis point drag and Bristol-Myers Squibb's 37 basis point drag show how individual underperformers can eat into overall gains. This highlights the dual nature of stock picking. Big wins propel the fund forward, but big losses can pull it back. Now, let us look at some key financial statistics. For the year ending the 30th of September 2025, the fund's net assets were a substantial $1,627,516,952. The total number of portfolio holdings stood at 34, which is on the lower side, confirming its nature as a more concentrated fund. This suggests a high conviction approach to investing, where the fund manager is very selective about the companies they invest in. The total advisory fees paid amounted to $8,526,156. This is a significant amount, but it needs to be weighed against the fund's performance and net assets. Notably, the portfolio turnover rate was 62.41%. This means that over the course of the year, about 2/3 of the fund's holdings were bought and sold. A higher turnover rate can sometimes indicate more active trading strategies, which can lead to higher transaction costs. But it can also mean the fund is adept at adjusting its portfolio to changing market conditions or capitalizing on new opportunities. Looking at the statement of operations provides a clear picture of the fund's financial activities for the year. Total investment income was just over $25 million, primarily from dividend income. However, the real story here lies in the net realized and unrealized gains from investment activities. The fund booked a staggering $371,888,898 in net realized gains from investment transactions. This, combined with a change in unrealized appreciation on investments of a negative $75,029,684, resulted in a net gain from investment activities of nearly $297 million. When you add that to the net investment income, the change in net assets resulting from operations for the year was over $312 million. This demonstrates a highly successful year in terms of generating profits from its investments. Let's dig into the schedule of investments to see where this money was actually made. The report details a significant allocation to common stocks, totaling over $1.6 billion. Among the top sectors, entertainment holds a large slice with 16.3%, including holdings in Live Nation Entertainment, TKO Group Holdings, Warner Bros. Discovery, and Warner Music Group. Pharmaceuticals is another major area with 11.9%, featuring substantial investments in Bristol Myers Squibb, Johnson & Johnson, and Novartis. The fund also has a significant stake in media with 11.1% holding positions in Fox Corp and News Corp. These are the core holdings that seem to have driven much of the fund's performance, especially considering the fund's strategy of focusing on companies with strong returns on capital and durable intangible assets. When we look at specific holdings, the fund has invested heavily in companies like Warner Bros. Discovery at $88.4 million, Live Nation Entertainment at $65.3 million, and Fox Corp, Class A at $71.2 million, all within the entertainment sector in pharmaceuticals. It holds Bristol Myers Squibb for $76.3 million and Johnson & Johnson for $71.4 million. This concentration in a few key sectors and specific companies tells us that the fund manager has strong convictions about the future prospects of these businesses. The statement of assets and liabilities gives us a snapshot of the fund's financial health on the 30th of September 2025. Investments are valued at over $1.6 billion. Interestingly, the fund also holds a significant amount of cash, over $73 million, which could be to meet redemptions, to take advantage of new opportunities, or as a strategic buffer. Total liabilities are around $89 million, and the net assets, as we've seen, are over $1.6 billion. The net asset value per S-share is $23.02. This is a healthy balance sheet showing a strong asset base relative to its liabilities. Now, the report also includes a clean opinion from PricewaterhouseCoopers, LLP, their independent registered public accounting firm. This is crucial because it means an outside auditor has reviewed the financial statements and found them to be presented fairly and in accordance with generally accepted accounting principles in the United States. This adds a layer of credibility to the fund's financial reporting. They have served as the auditor of one or more investment companies since 2011, which suggests a good deal of experience in this sector. The filing also details the basis for the approval of the investment advisory contract. The Board of Trustees reviewed the nature, extent, and quality of services provided by the advisor, the fund's investment performance compared to benchmarks and peers, the costs of services, and the potential for economies of scale. They specifically mentioned reviewing an independent report from Fuse Research Network, LLC, which compared the fund's performance to its peers. The advisory fee is noted as 0.58% of the fund's average daily net assets, and the advisor has a contractual agreement to limit total annual fund operating expenses to 0.85%. This indicates a focus on transparency and shareholder benefit, with the advisor taking on some financial risk through expense caps. The board concluded that the advisory fee and expense ratio were reasonable after comparative analysis. Now, let's put on our Warren Buffett hat and analyze what this all means. The Independent Franchise Partners Us Equity Fund has clearly had a stellar year. They successfully navigated a market environment that favored a narrow set of stocks. By sticking to their strategy of investing in companies with strong underlying fundamentals and durable competitive advantages, their stock selection, particularly in sectors like entertainment and pharmaceuticals, has paid off handsomely. The focus on a concentrated portfolio of 34 holdings suggests a high level of conviction in their chosen companies, which is often a hallmark of successful active management. The strong advisory fee of $8.5 million is justified by the impressive returns, especially when considering the fund's net assets. The relatively high portfolio turnover rate of over 62% may indicate a dynamic approach to portfolio management, actively adjusting positions rather than holding them passively. However, it is important to watch if this turnover leads to excessive trading costs in the long run. The fact that they managed to outperform benchmarks like the S&P 500 without owning the trendy tech stocks is a testament to disciplined investing. The fund's strategy appears to be robust, focusing on long-term value rather than short-term fads. The key risk for this fund, as with any concentrated portfolio, is the potential for a few poor performers to significantly impact overall returns, as we saw with Kenvue and Bristol Myers Squibb. However, the overall picture from this report is one of strong performance driven by thoughtful stock selection and a clear investment philosophy. The fund seems to be delivering on its promise of seeking an attractive long, term rate of return while managing risk. Alright, that is our deep dive into the independent franchise partners US equity funds shareholder report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and as always, subscribe for more corporate deep dives. Don't forget to check out the Discord community in the description for more discussions. Thanks for watching, see you next time.